Why does it feel like you've been paying your loan forever, but the balance barely moves? You make your payment on time, every month, the same amount, like clockwork. But when you check the outstanding principal, it's only gone down by a tiny fraction. It can feel disheartening, almost like you're running in place. This feeling isn't your fault, and you're not imagining it. The system of monthly payments, often called an EMI or equated monthly installment, is designed to feel manageable. It creates a predictable expense. But what it doesn't make clear is how your money is actually being used, especially in the beginning. It hides how interest is collected. Let's think about the average borrower. This is someone who does everything right. They found a loan, got approved, and have been diligent about paying it back on time. They assume that each payment is chipping away at the loan in a steady, linear way. Halfway through the loan term, they should have paid off half the loan, right? But that's not how it works. After years of payments, they look at their statement and a sense of confusion sets in. The loan balance is still surprisingly high. This confusion isn't an accident, it's a feature of the system itself. Banks and lenders don't use simple, straightforward division. They use a method called an amortization schedule. This schedule is the hidden map that dictates where every single dollar of your payment goes. It's the guide that determines how much goes toward the interest you owe, and how much goes toward paying down the actual loan amount, the principal. Here's how it works, step by step. When you take out a loan, you have the total amount you borrowed and an annual interest rate. The bank calculates the interest you owe for the first month based on the entire outstanding balance. In the early days of your loan, your principal balance is at its highest. Because of this, the portion of your fixed monthly payment that goes toward interest is also at its highest. A huge chunk of your payment isn't touching the loan itself, it's just paying the cost of borrowing for that month. Only the small amount left over goes to reduce the principal. Month after month, this process repeats. As you slowly chip away at the principal, the amount of interest you owe each month gets a little smaller. This means a slightly larger portion of your next payment can go toward the principal. It's a snowball effect, but in reverse. It starts incredibly slow and only picks up speed much later in the loan's life. This is why for the first few years of a long-term loan, it feels like you're making almost no progress. You are making progress, but most of your financial effort is being consumed by interest. Now here's a crucial point that many people miss. The loan tenure, the length of your loan, dramatically changes the total amount you pay. Two people could have the exact same loan amount, the same interest rate, and even a similar monthly payment. But if one person has a 15-year loan and the other has a 30-year loan, the person with the longer loan will end up paying significantly more in total interest over the life of the loan. The lower monthly payment of a longer loan comes at a very high hidden cost. This brings us to a moment of realization for many borrowers. Understanding this system is what gives you back control. It explains why making extra payments, especially early on, is so powerful. An extra payment made in the first few years goes almost entirely toward reducing your principal. This is because the scheduled interest for the month has already been covered by your regular payment. By lowering the principal ahead of schedule, you reduce the base on which all future interest is calculated. Every extra dollar paid early saves you many more dollars in future interest payments. Conversely, this also explains why making extra payments late in the loan's life feels less impactful. By then, your regular payment is already mostly going toward principal anyway, so the extra payment doesn't save you as much in future interest. The monthly installment was designed for comfort and predictability, not for clarity. It makes large debts feel affordable on a monthly basis, but it also obscures the true mechanics of how a loan is paid off. Once you understand how amortization really works, the system is no longer a mystery. Your loan stops feeling confusing. It stops feeling like a battle you can't win. Instead, it becomes predictable. You can see the path forward, and you now have the knowledge to navigate it more effectively.